You're expecting this strength to continue for a while?
Sure. So we do expect the dollar to stay stronger this year. So our range for the broad dollar is actually between 95 and 98. So it is slowly creeping up to the mid and towards the top end of our range. But we do think dollar strength broadly supported by the prospect of more Fed normalization ahead, a relatively stronger U.S. economy, especially compared with a few other DMs and broadly most emerging markets, as well as what you saw last night. And typically, when you have a more volatile market and a less positive risk outlook, dollar also tends to get bolstered. For this whole host of reasons, we do think this will be a year when dollar stays broadly stronger. That said, the move over the last couple of days has been pretty rapid, and a lot of hikes seems to be priced in at this point. So we wouldn't be surprised if at some point the market actually finds some stabilization just because of how much it's moved already.
What does that mean for emerging markets? Of course, a stronger dollar has also meant a downside for a lot of these developing nations, and we do have some Asian central banks really standing pat and not going along with the Fed. What will that mean in terms of their markets?
Yeah, that's a very good question. I think, generally speaking, when the Fed is starting to normalize policy rate, it has a ripple effect. Economies that are reliant on capital flows, dollar capital flows, or lower dollar financing rates. So that means a lot of emerging markets, broadly speaking. So we do think that this puts some pressure on some emerging markets. It will mean that their central banks may at some point need to bring forward their rate hikes as well. So that could happen to a lot of emerging markets this year. That said, within emerging market, there's all these other cross currents that are happening at the same time, right? Depending on how much an economy has already reopened and recovered, how much more room do they have to go? Are they being helped by the commodity uplift? Are they being helped by the global export story, which is still pretty robust at this point? Or are they just reliant on domestic services, which probably will remain quite vulnerable to how the COVID pandemic pans out? So within emerging market, there's likely going to be quite a bit of differentiation based on these other factors as well. So it's not really a broad-based case. There are still room to be quite selectively positive on some emerging markets, particularly here in Asia with regard to the big semiconductor names and the big names related to industrial upgrading, for example.
Yeah, tell me about some of those themes that you'll be opportunistic about, and particularly when you take a look at the divergence opportunities between the Fed and, say, the PBOC or other central banks.
Yeah, sure. So within Asia, in the equity space, we actually like the exporters, but not all of the exporters. We do think that we had to be mindful of higher inflation and the prospect of slower growth, at least in the near term in China, and some normalization in the U.S. So the economies that really stand out are actually the ones that did already pretty well last year, like Taiwan. South Korea, we think, has room to do better this year. We like Japan. These are industrial capex stories, and that remains something that we're quite positive on globally. We are looking for opportunities within Asia in terms of potential domestic reopening stories. So far, that seems to be progressing better than during the Delta wave. And markets we're looking at are Thailand and Indonesia. If we see more reopening domestically or externally, these markets could poise to come back. The markets we're still quite cautious at this point is China offshore. We do think that the regulatory implications for growth, profitability, and valuation it's still unclear at this point. So we're not yet calling for a turning around. But relatively speaking, within the China asset space, A-share may offer a little bit more of a protection, especially given that it's mostly invested by domestic investors, and it tends to have more names, more sectors that are related to domestic demand rather than those such as technology that are in the front and center on regulatory changes.
I know that you like Japan going into the end of the year. We heard from the BOJ yesterday, and Governor Kuroda still seems very comfortable with the weakness in the yen. Does that continue to drive some of the positive catalysts for Japanese equities?
Yeah, sure. So we do see the yen weakening versus the dollar this year, potentially to as much as 120. And that is a very clear reflection of the divergence in monetary policy between the Fed and the BOJ, as you say. So that should help to support Japanese exporters. We also think that Japan is a good story in terms of its investment in automation, which seems to be catching up globally. It's has good exposure, I think, to a lot of the secular growth that we like as well. That said, I think that it is not completely immune from the market volatilities we see in other developed markets, especially the U.S. So it tends to pull back at the same time. But broadly speaking, as we progress through the year, we think that fundamentals for recovery, especially in developed markets, it's still pretty solid, and policy stance are still pretty loose. So once we get through these bouts of volatility, we think that the yen markets are still poised to do well. We could see capital coming back to markets like Japan, which is still quite attractive from earning and valuation perspective.